Let me ask you a question. When was the last time you felt truly powerless? Not inconvenienced, but powerless. For many, that moment arrives not with a medical diagnosis or a personal loss, but with a piece of mail, a cold, impersonal letter, or perhaps a sterile online notification that informs you your three-digit number, the one you rarely consider, has quietly sentenced you to a diminished life, a life of systemic rejection. Today, I will not merely explain the mechanics of credit recovery. I will guide you through the visceral human experiences of individuals who discovered their financial shadow and the arduous path they took to reclaim their light. This is not theoretical finance. This is a chronicle of modern survival. We exist within a silent architecture of trust, quantified and distilled into a credit score. This number transcends its financial purpose. It becomes a key, one that unlocks or bars access to the fundamental components of the American aspiration. We understand this abstractly, yet the profound personal impact of its failure only crystallizes in moments of acute, mundane crisis. It is the sleek tablet computer declining your payment at the restaurant register, not with a loud alarm, but with a soft, apologetic beep that echoes in the sudden silence. It is the mortgage officer whose voice shifts from warm congratulation to clinical detachment as she quotes an interest rate that transforms a dream home into a financial prison. It is the human resources representative, days after a final interview for your ideal position, leaving a vague voicemail about proceeding with other candidates whose background aligned more closely with our requirements. In these moments, the abstract becomes a deeply personal betrayal. You have not changed. Your character, your work ethic, your potential remain intact. But your numeric proxy has mutinied, and you are now subject to a different set of rules, a life of no. Consider the story of Mark. To any observer, Mark was an unequivocal success, a lead software engineer in Silicon Valley, commanding a salary exceeding $150,000 annually. He drove a respectable car, lived in a well-appointed apartment, and contributed to his 401k. His financial identity, he assumed, was as robust as his professional one. The catalyst was an emergency appendectomy. Amidst the pain, recovery, and complex dance of insurance approvals, a single anesthesiology bill for $470 was misfiled and forgotten. It was not a willful neglect, but a human error in a moment of vulnerability. The bill, unbeknownst to him, was sold to a collections agency. Mark's awakening was not dramatic. It occurred on a Saturday morning as he applied online for a new rewards credit card to consolidate travel points for an upcoming vacation. The response was instantaneous. Application denied. Perplexed, he accessed his credit report. There, amid a sea of green checkmarks and flawless payment histories on six-figure credit lines, was a solitary, glaring red entry. A collection account, 180 days delinquent. His score had plummeted to 580. The cognitive dissonance was staggering. He possessed the liquidity to pay the original bill 50 times over, yet he was now categorized alongside the profoundly financially irresponsible. The system did not see Mark, the competent professional. It saw a defaulter. When he attempted to lease a newer car months later, the dealership, despite his documented income, offered terms with an APR typically reserved for high-risk borrowers. He was, in the parlance of the system, subprime. The shock morphed into a humiliating isolation. He was a high earner trapped in a debtor's cage, his economic mobility choked not by a lack of resources, but by a corrupted data point. His experience dismantles the most comforting myth that a substantial income inoculates one against credit failure. It does not. It merely changes the texture of the prison. This initial collision with credit failure triggers a predictable yet paralyzing psychological sequence. The first response is often a cold, primal fear, a realization that one's perceived stability is an illusion. This fear is swiftly compounded by a profound sense of shame. In a culture that equates financial management with personal morality, a poor credit score is internalized as a character flaw, a secret failing to be concealed. This shame fuels denial and avoidance. Confronting the credit report feels like reading an indictment. Behavioral economists identify this as a form of present bias, where the immediate psychological pain of facing the problem overwhelms the rational, long-term benefit of addressing it. We choose the temporary relief of ignorance, even as the long-term costs compound. The individual enters a downward spiral. Fear breeds shame. Shame fuels avoidance, and avoidance guarantees the problem will fester and grow. The machinery of credit, the compounding interest, the late fees, the relentless reporting, continues to operate with impersonal efficiency, deepening the hole while the victim stands frozen at the edge, unable to look down. Mark's story, and the countless others like it, reveal an uncomfortable and foundational truth. The architecture of consumer credit, while ostensibly a tool for measuring risk, is perversely incentivized by failure. Late fees, penalty APRs, and the lucrative trade in distressed debt are not bugs in the system. They are profitable features. The system, in its current form, derives significant revenue from those who stumble. It is not optimized for your rehabilitation, but for your ongoing profitable distress. Therefore, a genuine credit recovery cannot be a passive appeal to the system's mercy. It must be a deliberate, strategic, and quiet rebellion. A rebellion that begins not with a bold declaration, but with the courageous, terrifying act of opening an envelope, logging into an account, and staring directly at the bloodied ledger of your own financial life. The autopsy must come before the resurrection. Rebellion begins with intelligence. Before a single strategic move can be plotted, before a single dispute letter is drafted, you must perform a forensic audit on your own financial identity. This is the most psychologically demanding phase of the entire process, conducting an unflinching autopsy on the corpse of your creditworthiness without succumbing to the urge to look away. It requires a clinical detachment that feels at odds with the deeply personal nature of the information. You must become both the subject on the table and the pathologist holding the scalpel. The first step is to understand that the 3-digit score is merely the headline. The real story, the damning evidence, or the path to exoneration lies within the credit report itself. Think of your credit report not as a report card, but as a comprehensive character dossier compiled by 3 private corporations, Equifax, Experian, and TransUnion. This dossier is not written for you. It is written for lenders, landlords, insurers, and even potential employers to answer one fundamental question: how much risk do you pose? Every entry, every line item contributes to a narrative about your reliability, your stability, and your predictability. The core components of this narrative are deceptively simple. Payment history, 35% of the score. This is the bedrock of your financial character. It is a binary, unforgiving log of promises kept or broken. Every on-time payment is a brick in your fortress. Every 30, 60, 90-day late mark is a structural crack. Derogatory items like charge-offs, collections, bankruptcies, and foreclosures are the equivalent of collapsed walls. Credit utilization, 30%. This measures the proportion of your available credit you are currently using. It is a gauge of your desperation or your discipline. Exceeding 30% of your limits and certainly maxing out cards signals dependency and potential distress. The system interprets high utilization as a prelude to failure. Length of credit history, 15%. This is the chronicle of your experience. A long, well-managed history demonstrates a proven, sustained ability to handle debt. A short history, or one punctuated by newly opened accounts, provides insufficient data for trust. Credit mix, 10%. This assesses the diversity of your debt portfolio. The system favors individuals who can responsibly manage different types of credit: the revolving debt of credit cards and the installment debt of auto loans, student loans, or mortgages. It is a test of versatility. New credit, 10%. Every hard inquiry from a credit application is a note of ambition or anxiety. Too many inquiries in a short period suggest you are seeking financial lifelines, a potential sign of instability. To grasp the visceral terror and violation embedded within this dossier, let us turn to Elena's story. Elena was a public school teacher, a woman of meticulous habit and order. Her finances were simple, built around a modest salary, a single credit card used for groceries and gas, and her student loans. Her awakening arrived via a pre-approved credit card offer for a luxury retail chain she would never frequent. The interest rate was usurious. A flicker of concern led her to her annual credit report. There, amidst her familiar accounts, she discovered 3 active credit cards and a small personal loan she had never applied for. The accounts had been opened over the preceding 8 months, were all nearing their limits, and were severely delinquent. Her score, once in the mid-700s, had been demolished. Elena's case is a profound violation, the identity ghost. It is the realization that your financial identity, your digital shadow, can be detached, possessed, and mutilated by a stranger. The emotional response transcends the financial. It is a potent mix of fury, vulnerability, and a surreal sense of defilement. Her path forward could not be one of negotiation or gradual repair. It demanded an immediate, aggressive, and documented campaign of eradication. This involved steps that feel more akin to filing a police report after a burglary than managing personal finance. Placing immediate fraud alerts with all 3 bureaus, filing detailed FTC identity theft reports, disputing every fraudulent account in writing with certified mail, and yes, filing formal reports with local law enforcement to create an official paper trail. Her battle was not against her own habits, but against a phantom. It underscores a critical lesson. The first task of the autopsy is to determine if the wounds on your report are self-inflicted or the work of an external attacker. The protocols for each scenario are fundamentally, irrevocably different. For those, like our software engineer Mark, whose wounds are self-inflicted, the autopsy reveals a landscape of hard truths and strategic choices. You will encounter the zombie debts, old collections that seem to resurrect just as they are about to fall off your report. You will stare at charged-off accounts where the original lender has given up on collection but sold the debt for pennies on the dollar to agencies whose business model is predicated on intimidation and volume. Here, you enter the complex arena of resolution. This is where you must choose your battles with the cold precision of a general assessing a battlefield. You have several tactical options, each with distinct consequences. You can dispute inaccuracies. If a date is wrong, a balance is incorrect, or an account isn't yours, with the bureaus directly. This is your right under the Fair Credit Reporting Act. For legitimate debts, you may engage in debt validation, forcing the collection agency to prove they own the debt and have the legal right to collect. This can sometimes cause an unprepared agency to simply drop the matter. Then there is the most delicate negotiation: settlement. This involves offering a lump sum payment, typically for less than the full amount owed, in exchange for the account being reported as settled, or, in the ideal but increasingly rare outcome, paid in full. The hard truth is that pay for delete, paying in exchange for the entire negative entry being removed from your report, while a powerful concept, is not a practice officially sanctioned by credit scoring models and is inconsistently honored by collectors. Pursuing it requires careful, documented communication. The critical lesson of this phase is that every action, every payment, every dispute, every settlement sends a new data signal to your dossier. A settled collection is a different narrative than an unpaid one, but both are chapters in a story of past failure. The goal of the autopsy is not to find a magical eraser, but to accurately map the terrain of damage so you can plan the meticulous, patient work of reconstruction that must follow. Understanding the battlefield is only step 1. The real transformation begins when you cease reacting to the system's judgments and start proactively engineering a new, irrefutable narrative of reliability. Following the autopsy, that stark, unflinching assessment of the damage, a perilous inertia can set in. The landscape of your credit report is mapped, the enemies identified, but the path forward seems obscured by a fog of complexity and apparent scarcity. This is the critical juncture. Recovery does not happen through understanding alone, nor through the passive hope that time will heal all wounds. It requires a shift from a defensive to an offensive posture. You must move from being a subject of the system's judgment to becoming an architect of your own new financial identity. Your credit score is a shadow cast by your financial behavior. To change the shape of that shadow, you must deliberately and precisely alter the substance that stands in the light. The foundational strategy for this reconstruction often begins with what is colloquially termed a loophole, but is more accurately described as a strategic leveraging of the credit reporting system's own design. This is the practice of becoming an authorized user on the credit card of a trusted individual, typically a family member or a partner with a long-standing account in impeccable standing. The mechanics are simple. The primary account holder adds you to their card, granting you spending privileges you may never exercise. The profound effect lies in the reporting. The entire history of that account, its age, its payment record, its credit limit, can be imported onto your credit report. This is not a financial transaction. It is a reputational transplant. You are, in essence, borrowing the proven positive financial narrative of another person to fast-track the establishment of your own. The primary account holder's responsible behavior casts a positive shadow on your profile. However, this strategy is imbued with profound gravity and mutual risk. It requires a relationship of absolute trust, for any misstep by the primary holder, a late payment, a spike in utilization, now damages both parties. The authorized user must view this privilege not as a source of spending power, but as a sacred stewardship of someone else's financial reputation. It is a pact, a quiet alliance against the system's skepticism. For those without access to such an alliance, or for whom it is insufficient, the blueprint requires building from absolute zero. This is where we turn to David's story. David's financial life had been obliterated by a perfect storm, medical debt from an uninsured accident, followed by a period of unemployment. His credit score sat at 500, a number signaling near total exclusion from the mainstream financial world. His income, once robust, was now modest and irregular as a freelance graphic designer. David's approach could not rely on income or traditional loans. It had to be surgical, behavioral, and relentlessly consistent. His first tool was a secured credit card. He saved $300, which he deposited as collateral with a reputable issuer. This sum became his credit limit. Most narratives stop here. Get a secured card and use it. David's strategy was in the microscopic management of its use. He understood the paramount importance of credit utilization. He did not wait for the statement. Instead, he used the card for a single, small, recurring expense, his monthly streaming subscription, amounting to less than $15. He then paid the balance in full, often before the billing cycle even closed, ensuring that the balance reported to the credit bureaus was never more than 5% of his limit. He was not using credit to spend. He was using a financial instrument to send a flawless monthly signal of control and reliability. It was a performance, meticulously staged for an audience of algorithms. After 6 months of perfect payment, his issuer rewarded his behavior by returning his deposit and converting the card to an unsecured one with a higher limit. This was his first victory. He then faced the credit mix challenge. His profile was all revolving credit. To demonstrate his ability to handle different types of debt, he researched and obtained a small, fixed installment credit builder loan. These products, often offered by credit unions or community banks, function in reverse. The loan amount is held in a locked savings account while you make payments. Upon completion, you receive the funds plus any accrued interest. The purpose is not the money. It is the creation of a perfect 12-month payment history on an installment loan. David integrated this payment into his budget as a non-negotiable expense. Every on-time payment was another brick in his new foundation. David's toolbox also included modern fintech solutions that reframe existing financial behavior as creditworthy. He used services like Experian Boost, which allows individuals to add their on-time telecom and utility payments to their Experian credit file. For a man with a thin credit file, this was not a gimmick. It was a way to recruit new character witnesses, his gas company, his electric provider, to attest to his reliability. He treated these tools not as magic, but as logical extensions of his strategy, to saturate his credit report with as many positive contemporary data points as possible, thereby diluting the impact of past negatives. This entire phase demands a fundamental mindset pivot. You are no longer merely a consumer of credit. You are an engineer, and your credit report is your project site. Every financial action is no longer just an exchange of value. It is a data signal with intended consequences. A payment is a signal of predictability. A low reported balance is a signal of restraint. Diversifying your credit types is a signal of sophistication. You are consciously constructing a new narrative, piece by deliberate piece, to be read by the very systems that once rejected you. The goal is to make your new financial identity so unambiguous, so consistent, and so verifiable that the system has no logical choice but to acknowledge your transformation. The shadow must eventually conform to the new shape of the substance. The process of credit recovery is frequently misrepresented as a linear upward trajectory, a simple matter of implementing the correct tactics and watching the number climb. This is a dangerous fiction. The data on your report may improve in a somewhat predictable manner, but the human experience of rebuilding is not linear. It is a psychological marathon characterized by grueling plateaus, unexpected setbacks, and the profound mental fatigue that comes from sustaining a disciplined performance for an audience of faceless algorithms over months, even years. To succeed, you must armor yourself not only with financial knowledge, but with psychological resilience. The emotional cycle of a credit rebuild is a distinct and taxing journey. The initial phase, after the autopsy and the first strategic steps, is often one of cautious optimism. You have a plan. You are taking action. The first points of improvement, perhaps from lowering utilization or correcting an error, provide a tangible reward. However, this optimism inevitably collides with the plateau of despair. This is the period, often lasting several billing cycles, where your diligent efforts, the on-time payments, the microscopic utilization, yield no visible score increase. The complex FICO and VantageScore algorithms weigh new behaviors against the backdrop of your entire history. Recent positive actions are filtered through the older negative data. During this plateau, motivation evaporates. The voice of doubt whispers that your efforts are futile, that the system is rigged, and that you are condemned by your past. This is not a sign of failure. It is a predictable, almost universal phase of the process. The key is to recognize it for what it is, a test of process over outcome. You must learn to derive satisfaction from executing the plan perfectly, not from the delayed and often frustrating feedback of the score itself. The true test of any recovery blueprint, however, is not the plateau, but the unforeseen crisis. A plan that cannot withstand a real-world shock is merely a theory. Let us return to Mark, our high-earning software engineer from Part 1, who was diligently rebuilding after settling his medical collection. He had secured a credit builder loan and was meticulously managing a secured card. His score had climbed from 580 to a promising 660. Then, his aging car's transmission failed. The repair cost was $2,800, an amount he could not cover from his checking account without jeopardizing his rent. Faced with a binary choice, miss a rent payment or utilize his available credit, he used his primary credit card for the repair, which increased his reported utilization from 8% to 65% in a single statement cycle. His score promptly plunged by 42 points. This was a defining moment. The old Mark might have spiraled into shame and abandonment, viewing the drop as proof of his inherent financial incapacity. The new Mark, however, had been tempered by the process. His response was a clinical exercise in damage control, devoid of panic. First, he did not hide from the data. He analyzed it. He understood why the drop occurred, utilization spike, and that this factor has no memory in most scoring models. Second, he immediately executed a counter strategy. He made a large payment mid-cycle before the next statement date to bring the balance down. He contacted the card issuer to explain the situation and inquire about a credit limit increase to lower his utilization ratio, leveraging his perfect payment history with them. Third, and most importantly, he did not abandon his other positive habits. He continued his payments on the credit builder loan on the exact same day, every month. He recognized the setback for what it was, a tactical loss in a strategic war. His score recovered within 2 months, but the greater victory was the hardening of his financial psychology. He learned that resilience is not the absence of failure, but the methodical, unemotional response to it. This episode underscores a non-negotiable parallel structure to any credit rebuild: building financial shock absorbers. Credit repair focuses on your external financial identity. Shock absorbers are about your internal operational liquidity. They are the foundation upon which your new credit identity must stand. The goal is to amass, however slowly, a small cash reserve, a micro-emergency fund of $500, then $1,000, that exists specifically to absorb these inevitable shocks without forcing you to breach the disciplined protocols of your credit strategy. This fund buys you the most valuable commodity in recovery: time and options. It allows you to handle a car repair, a medical copay, or a broken appliance without triggering a utilization disaster, or worse, missing a payment. Without this buffer, you are attempting to build a stone fortress on quicksand. The first tremor will swallow your progress. Finally, as the climb continues and scores begin to approach the good and very good thresholds, the 60, 70, 740 range, a new and seductive danger emerges: the temptation of the new you. Lenders and credit card companies, whose algorithms now flag you as a promising prospect, will begin to flood your mailbox with pre-approved offers featuring attractive sign-up bonuses and rewards. It is intoxicating. After years of restriction, the system is finally offering you its gifts. This is the moment of greatest peril, where the goal can subtly shift from building creditworthiness to consuming credit. Succumbing to this, opening multiple new accounts for short-term rewards can trigger hard inquiries, lower your average account age, and restart the cycle of potential mismanagement. The mature philosophy that must emerge from the marathon is one of intentional use. Credit is not a reward for good behavior. It is a tool for specific, life-enhancing purposes: securing a manageable mortgage on a home, financing a reliable vehicle, or responsibly managing cash flow. The ultimate aim is not a perfect 8 and 50, but a score sufficiently strong to grant you access to the world's opportunities on favorable terms, and the wisdom to use that access sparingly and strategically. You are no longer running a sprint to escape a number. You are conditioning yourself for a lifetime of sustained financial health. One day, it happens. The transition is so gradual you may not notice it immediately. You apply for something: a refinance on your auto loan, a new apartment lease, and the process is not an obstacle course of anxiety. It is instead a series of mundane formalities. The loan officer does not speak in tones of cautious concession, but in the flat, efficient language of standard procedure. The apartment application is approved without a requirement for a cosigner or an additional security deposit. The fear, that low-grade hum of dread that accompanied every financial interaction for years, is simply absent. You have not just improved a number. You have crossed an invisible frontier into a different financial reality. This is the quiet, profound victory of credit recovery. It is not the triumphant blare of a trumpet, but the deep, resonant silence of a door that no longer bars your way. This new reality is characterized by a fundamental shift in agency. You are no longer a supplicant petitioning a system for leniency. You have become a client evaluating its offerings. When you receive a credit card offer, you scrutinize its terms, the APR, the reward structure, the ancillary benefits, not with the desperation of someone seeking approval, but with the discernment of someone comparing tools. You can choose a cashback card for groceries, a travel card for flights, or decline them all, secure in the knowledge that your financial identity is not dependent on any single line of credit. The power dynamic has inverted. Your diligently engineered credit profile now works as a silent advocate, negotiating on your behalf for lower interest rates, better terms, and greater access. It has transformed from a mark of suspicion into a certificate of reliability. Let us revisit our protagonists and witness the tangible outcomes of their journeys, not merely in points recovered, but in lives reclaimed. Mark, the software engineer imprisoned by a forgotten medical bill, now owns a home. His recovery journey, complete with its transmission repair setback, demonstrated a resilience that mortgage underwriters value. He did not just present a 740 credit score. He presented a 2-year history of flawless payments across multiple account types and a documented history of responsible credit management through a crisis. The 3.5% down payment FHA loan he once would have needed was replaced by a conventional mortgage with a 20% down payment and an interest rate that will save him over $100,000 across the life of the loan. His numeric comeback directly purchased geographic and financial stability. Elena, the teacher violated by identity theft, channeled her hard-won expertise into a side enterprise. After eradicating the fraudulent accounts and rebuilding her own score into the high 700s, she began offering notary and basic financial document organization services for elderly neighbors in her community. Her personal experience with fraud prevention made her uniquely qualified. She then utilized her pristine credit to secure a small business line of credit, not because she needed the capital immediately, but to establish a commercial credit profile, separating her personal and budding professional finances. Her recovery enabled a new chapter of entrepreneurial agency. David, who rebuilt from 500 through microscopic management, now volunteers as a financial coach at the local community center where he once obtained his credit builder loan. He does not teach complex investment strategies. He teaches the fundamental mechanics of the secured card, the psychology of the plateau, and the critical importance of the $500 emergency fund. His lived experience, more valuable than any textbook theory, provides a credible roadmap for others standing where he once stood. His comeback story created a new purpose, becoming a guide through the terrain he conquered. The culmination of this process is not the attainment of a perfect 850 score, a pursuit that often becomes a hollow, resource-draining game. The true culmination is the adoption of a guardian mindset. You are no longer a combatant fighting your credit, nor an engineer building it. You are the guardian of your financial identity. This is a permanent, vigilant orientation. It involves the ongoing routine monitoring of your credit reports for inaccuracies or new signs of fraud. It means using credit intentionally and strategically, understanding that every financial decision is a data point that will be recorded and assessed. Perhaps most powerfully, it grants you the ability to say no, to decline high-interest financing, to avoid unnecessary debt for depreciating assets, and to reject the constant cultural pressure to consume on credit. You guard your score not for its own sake, but because it represents the hard-won key to your optionality and security. Conclusion. Credit recovery, as evidenced by these real-life examples, is fundamentally mischaracterized when viewed as a series of financial tactics. It is, in its essence, a profound process of reclaiming agency. It is the deliberate, often grueling journey of taking back the narrative of your financial life from a reductive, unforgiving number that sought to define your limits. You move from being defined by past financial data to consciously authoring the data that will define your future. Your story has the potential to be a credit comeback story. Every narrative of recovery, from Mark's to Alina's to David's, began not with a windfall or a magical solution, but with a single, deliberate choice. The choice to confront the reality of their situation and to commit to the process. That first chapter is the only one you need permission to write, and you grant that permission to yourself. If this exploration has resonated with you, if you have felt the shock of recognition in these struggles or the spark of possibility in these strategies, then your starting point is clear. This is where the deeper work begins. We dedicate ourselves to expanding upon these blueprints on our YouTube channel, Credit Comeback Stories. There, we deconstruct these strategies with granular detail, interview individuals who have lived through every stage of this journey, and foster a community focused on empowerment, not judgment. We provide the ongoing analysis, the advanced tactics, and the moral support necessary to navigate the marathon. Subscribe and hit the notification bell. Do not let your comeback be a story you only hope for. Let it be a story we help you document, strategize, and achieve. Find the link below to join a community that understands the map, because we have walked the terrain ourselves. I will see you in the next video.